Center for Financial Research. Sorry to set you up like that, Cooper. Hard to beat flying cars from a Treasury perspective.
Yeah, I don't blame you, but I will ask, what is the difference between a flying car and an airplane? I mean,
Right.
aren't they one and the same?
But I think you're probably onto something there. Shorter distances, maybe. Pick up your kids and take them. Well, I guess you could do that in the plane, too. How about yields? They're kind of flying, Cooper, again today, even with crude oil just disappearing before our eyes. Bond sellers, what do you make of it?
Yeah, so all joking aside, we're seeing a little bit of a move up. I don't think that it's too large of a move up there, Oliver. I think really kind of what it is just a continuation of the really trade that we've seen over the past 6 weeks. And really, that's just the impetus for a lot of that is that the economic data has been coming in better than expected. So you looked at ever since the original non-farm payroll report came out, things have been looking pretty good in the economy. So I think that's really kind of where we're looking at today.
Okay. Now, the data this week, what do you think type of power it's packing here? Because we've got a lot of tech stuff going on for earnings, but with all of the top line economic information, should that be driving the bus for bonds?
Yeah, so we're going to get a lot of data this week. And I think that it does have the impetus to potentially move where the market is going or potentially move kind of expectations for where Fed policy is going. We know that we're going to get jolts. I think what's going to be interesting to watch for that tomorrow is what's the hiring numbers, what's the quits numbers? Do we see kind of quits continuing to move lower, signaling maybe that the economy or the labor market is not as strong as we expect? Then if we fast forward all the way to Friday, that's going to be the big non-farm payroll report. I wouldn't be too surprised if it's a little bit of a kind of mixed picture as far as the report comes out. It's going to be difficult to parse through the numbers because we might have the impact of the hurricanes. We're also going to have the impact of the Boeing strike. So it really won't be fully clean data to kind of dig through and see what that impact is. And then if we even fast forward to next week, it's obviously the election. So that could be another source of volatility, Oliver.
And how does that rank right now, Cooper? Has there been any further clarity on the bond market's connection to policy, or is that still a second or third fiddle in the catalysts for bonds?
You know, I know that there's been this narrative out there that the reason that Treasury yields have been moving up is because of certain candidates' odds in the gambling markets have moved up as well. I really think that it's more tied to the economic data. That's more what drives Treasury yields longer term. So I think that's really been what's the characteristics of kind of why the move up in yields have been, not one candidate or another. And really, when it comes down to politics, Oliver, what we've been suggesting to our clients is that it's really way too early to be making any sort of moves in your portfolio based off of one candidate or another. We do suggest try to keep politics outside of your trading views, outside of your investing views.
Okay. Amen to that. All right. The 10s to the 2s getting crunched a little bit. It was a nice bear steepener after the Fed cut, but if the data come in too hot, does that start to mess up our 25 bips after the election? How locked in do you think that move is, Cooper?
You know, the market does expect 25 bips. It's a pretty high probability. I think that's reasonable at this point. I don't really think that there would be too much to kind of shift one way or another to do the September meeting, the November meeting, thinking ahead.
Yeah.
But I do think later on down the road, the December meeting, depending on where the economy goes, where the data comes in, then that has the potential to shift one way or another. I would not be surprised if the Fed takes this rate cutting cycle at a slow and methodical pace and moves rates down depending on where the data comes in. They want to take their time. They don't want to overreact. They don't want to go too aggressively. So I, again, think it's probably going to be a slow, methodical pace. Our view, Oliver, in terms of the yield curve is for it to continue to steepen, led by lower short-term yields. I think probably the move up in longer-term yields, unless we get surprisingly strong economic data, seems to be that we probably don't have too much more upside on long-term yields from here.
Okay. You guys generally more in the kind of bull steepener camp than the bear one, still generally. So this kind of being sort of a reversion within the larger trend of the bull. Appreciate it, Cooper. Thank you very much.